Hello traders, on this video we would like to address a question arising from a trader that touches on bull markets and bear markets as the trader and his crypto trading friends mentioned during their interactions. Typically, bull and bear markets are terms that are commonly used in financial markets to describe the overall sentiment or the overall trend in a market or an asset. These terms are often associated with stocks, but they are also applicable to other financial instruments, including foreign exchange market. As such, it is important for forex traders to understand what a bull market means and what a bear market means. A bull market simply means that the bulls reign in the market. People are usually looking to invest their money into the market. That is, confidence is high and the acceptance of risk is generally up. That is, confidence is usually high and the acceptance of risk is usually up. As such, this leads to rise in various markets, particularly in stock markets, but also in forex currencies such as the Australian dollar, Canadian dollar, New Zealand dollar, and also emerging market currencies. Conversely, bull markets typically lead to a decline in safe haven currencies such as the Japanese yen, the Swiss franc, and in some instances, the US dollar. So what are some of the characteristics of the bull market? One of the characteristics of bull markets is rising prices. A bull market is characterized by a sustained upward trend in asset prices. The next characteristic is optimistic sentiment. Investors and traders generally have a positive outlook on the market and expect continued growth during a bull market. The third characteristic is high trading volumes. Bull markets often see increased trading activity as some participants join the buying spree. This leads to increase or rise in trading volumes. The other major characteristic of bull market is economic expansion. Basically, bull markets are often associated with periods of economic growth and positive macroeconomic indicators. So, some of the trading strategies that traders utilize to trade the bull market include trend following and buy and hold strategies. Basically, in a bull market, traders often employ trend following strategies during which they buy assets with the expectation that the upward trend will continue. The other strategy we've seen is buy and hold. Usually, some investors or most investors usually adopt a buy and hold strategy, riding the upward trend and holding onto positions for an extended period before they can take their positions or before they can take their profits or before they can exit their positions. Now, the bear market, on the other hand, typically, bear markets follow a downward trend as investors sell risky assets such as stocks and less liquid currencies such as those from emerging markets. During a bear market, traders are looking to enter the market when prices are falling so that they can buy once they believe that the market has reached its peak and make their profits. It's worth noting that the United States dollar and the Japanese yen, which are safe haven currencies, tend to strengthen in a bear market as riskier instruments are sold off and safe haven currencies are usually in demand. So, some of the characteristics of a bear market include falling prices. A bear market is usually marked by sustained downward trend in asset prices. Basically, if you took a position in a bear market, you'll notice that the price will continue falling in whichever asset you're taking a position on, so that if you are short the asset, then you'll make profit as the market continues to fall. The other characteristics of a bear market is pessimistic sentiment. During bear markets, traders and investors are usually or are generally pessimistic. That is, they are usually expecting the market to continue declining. The third characteristic of bear market is there is increase in volatility. Bear markets can be more volatile, with sharp price declines and increased uncertainty. As such, traders are advised to be wary of these conditions so that they can trade wisely. Typically, these are not usually the best time to trade, and there is totally a lot of fear in the market during bear markets. The final characteristic is economic contraction. Bear markets are often associated with economic downturns and negative macroeconomic indicators. And these are some of the leading factors or the leading drivers of the market towards its downward trajectory. So, which are some of the strategies that are employed by traders to trade during the bear market? Basically, there are three main strategies that are employed by traders, which include short selling, in-fast ETFs, and risk management. So what you see is that in a bear market, traders may engage in short selling, that is, selling assets they don't own with the expectation of buying them back at a lower price. The other strategy is in-fast ETFs. Traders can use in-fast exchange traded funds, that is, ETFs, to profit from the falling markets. The other paramount strategy is appropriate risk management. Given that there is increased volatility during bear market, risk management becomes paramount. Setting stop loss orders and managing position sizes are important to mitigate potential losses during the bear markets. However, as we come to a conclusion, we'd like to mention that it is important to note that markets often transition between bull and bear phases, and identifying these transitions is a key skill for traders. Whichever market one is trading, it is worthy noting that technical analysis, fundamental analysis, and a good understanding of market psychology are essential components for successful trading in both bull and bear markets. Again, risk management should always be a priority to protect capital in any market environment when trading. Thank you for watching. Let us interact again in our next video.